Imagine ringing up over $12.4 billion in record-breaking sales.
Right, just a staggering number.
Seriously. I mean, absolutely crushing Wall Street's revenue expectations, expanding your market share across the board, and your reward is losing nearly $1 billion in market value in a single afternoon.
Yeah, it's brutal.
Welcome to the deep dive. We know you are an experienced investor, looking for the signal through the noise, and today we are looking at a diagnostic picture that is fundamentally broken.
Completely broken.
We're aiming our microscope squarely at Ulta Beauty's Q4 and full year 2025 earnings call. This just dropped on March 12, 2026, by the way.
And I gotta say, the fallout from this specific call, it's a masterclass in how modern markets process information.
Oh, totally.
Because the headline numbers were, a superficial dream, but the institutional reaction was swift, violent, and just completely unforgiving.
Total whiplash. Let me give you the result snapshot, because at first glance, you would assume the market was breaking out the champagne.
Right, popping bottles.
Exactly. Full year net sales hit that $12.4 billion mark. Q4 revenue came in at $3.898 billion.
Which is fantastic.
It is. That is up a very healthy 11.8% year over year, comfortably beating the street estimates, which were clustered around $3.81 billion.
Yep.
Comparable sales or comps, which measure the revenue from stores open for at least a year to filter out the artificial boost of just opening new locations, those are up 5.8%.
And market share is growing across both mass and prestige beauty.
They even expanded their active loyalty members to a record 46.7 million.
Which is why the subsequent price action feels so jarring to a casual observer. I mean, if you only read the top of the press release, the narrative is just flawless execution.
Yeah, but we have to reflect the grim reality of what actually happened the moment the market digested the entire document.
Right, when they actually read past page 1.
Exactly. Despite that massive top-line beat, the stock completely cratered in the next regular session close. It plunged over 8%.
Ouch.
Yeah, an absolutely brutal $50 drop per share. Over $930 million in trading value exchanged hands as investors just, rushed for the exits.
So it was a bloodbath.
So the core tension we are exploring for you today is this. Why did the market violently punish a company that just reported record-breaking holiday sales and undeniable market share gains?
Well, to understand that massive haircut, we have to look past the top-line glitz and dig into the bottom-line grit.
Right.
The market didn't punish the revenue, right? The market punished the sheer ballooning cost required to generate that revenue. We're watching the underlying cost of doing business finally catch up to the growth narrative.
Okay, let's unpack this, because the sales mechanics driving that top line really are genuinely impressive. We need to give credit where it's due.
Absolutely.
That 5.8% comp growth wasn't just them raising prices to keep up with inflation. It was driven by a 4.2% increase in the average ticket size.
Meaning shoppers are putting more items or, more expensive items in their baskets.
Yeah, exactly. And a 1.6% rise in actual foot traffic and transactions. They saw massive wins in fragrance, pulling in double-digit comp growth.
Fragrance has been huge for them.
Hair care had its best quarter of the year, and management specifically called out Beyoncé's Sacred as the largest prestige hair launch in Ulta's history.
Which is a massive win.
Add in strong performances from Rare Beauty, Fenty's Diamond Collection, and KVD brands like Peach and Lily, and the merchandising strategy is clearly working.
Oh, the revenue engine is undeniably firing on all cylinders, but here's the profitability problem that sent the algorithms into a selling frenzy.
Okay, lay it on us.
Gross margin dipped just 0.1%, a mere 10 basis points, landing at 38.1%.
I mean, that in itself is practically a rounding error in retail.
Exactly. The real shocker was the operating margin. This is the metric that shows how much profit a company makes on $1 of sales after paying for variable costs, but, before paying interest or tax.
Okay.
Ulta's operating margin plummeted from 14.8% last year down to 12.2%.
Wait, a 260 basis point drop in operating margin? That is a massive red flag.
It changes the entire valuation model. And the culprit for that margin compression is SG&A selling, general, and administrative expenses.
So overhead and payroll.
Everything from store payroll and corporate salaries to marketing budgets and software subscriptions. Ulta's SG&A skyrocketed 23% year over year.
23%.
Yeah, crossing the $1 billion mark for a single quarter. As a percentage of sales, SG&A rose from 23.4% to 25.7%.
Wait, if they had a relatively stable gross margin, shouldn't those record-breaking sales have flowed a bit more smoothly to the bottom line?
You would think so.
Let's talk about retail's biggest villain lately. Inventory shrink. I mean, theft has been destroying margins across the sector. Did Ulta just get hit harder by shrink than they anticipated?
Well, what's fascinating here is the underlying anatomy of that SG&A bloat, because it's actually the exact opposite of what you might expect.
Wait, really? The opposite?
Yeah. Management successfully executed on that major retail headwind. Through heavy upfront investments in locking fixtures in high-risk markets and extensive associate training, they meaningfully reduced theft and shrink across every category.
Okay, but how does that hurt the bottom line?
Because there is a fascinating irony in how retail compensation structures work. By successfully reducing theft, store performance improved dramatically.
Ah, I see where this is going.
Right. Because store performance improved, the store managers and field teams blew past their internal sales targets. And because they beat those targets, they triggered massive mandatory bonus payouts to their frontline workers.
Oh, wow. So their very success in fixing the shrink problem created a massive expense on the payroll line.
Exactly. They effectively traded a merchandise loss for a payroll expense.
That is wild. But surely, employee bonuses alone don't add up to a 23% spike in SG&A. What else is draining the coffers?
You have two other massive buckets weighing down the bottom line. First, they deployed heavy marketing media spends and corporate overhead to support their aggressive growth targets.
Okay, and the second?
Much more significantly, they had to absorb the operating costs of their recent Space NK acquisition.
Right, the UK brand.
Yeah, but they didn't just buy a brand, they bought 86 physical luxury stores in the UK and Ireland. Integrating an international acquisition is notoriously expensive.
Oh, I can imagine.
You're dealing with merging legacy point-of-sale systems into Ulta's central architecture, establishing new vendor contracts in foreign currencies, managing transatlantic supply chain logistics.
Not to mention entirely different labor and tax laws.
Exactly.
It's like they're running two completely different companies under one roof. They have their highly profitable legacy U.S. brick-and-mortar stores funding the construction of a massive, expensive tech and international startup.
That's a great way to put it.
The traditional retail engine is roaring, but it's dragging this heavy, cash-burning, digital and global anchor behind it.
That is the perfect way to visualize the tension. And management isn't apologizing for this billion-dollar SG&A bill. They are actively leaning into it.
They are.
Yeah, they're looking at that shrinking operating margin and framing it as the necessary cost of building their new competitive moat, a strategy they've dubbed Ulta Beauty Unleashed.
Okay, let's dive into that, because Ulta Beauty Unleashed sounds like a marketing slogan, but it's really an aggressive omnichannel and international land grab.
It really is.
They're spending heavily, and we need to look at where that capital is actually going.
Yeah.
We mentioned the 46.7 million loyalty members earlier. That's a 5% bump in their core audience.
Yep.
Their e-commerce is growing in the mid-teens, and an incredible 60% of all online sales are now transacted directly through their mobile app. Active app users are up 15%.
And that mobile app metric is crucial. A dedicated app user is, exponentially more valuable than a casual website visitor.
Because of the data.
The data, the access. The app is essentially a digital flagship store sitting in the pockets of millions of people. It's sending them push notifications, utilizing augmented reality for virtual try-ons, and harvesting incredibly granular data on their purchasing habits.
And internationally, they aren't just relying on that expensive Space NK integration in the UK. They are expanding their footprint through asset-light partnerships, teaming up with Grupo Axo in Mexico and Alshaya in the Middle East.
They're going global fast.
Domestically, they're pouring tech capital expenditures into conversational AI for guest services to streamline customer resolutions, building an AI-powered order management system to reduce out-of-stocks. And this is a big one, preparing for a highly anticipated launch on TikTok Shop coming next week.
Yeah, the TikTok Shop integration is a massive logistical undertaking. It is designed to capture the Gen Z impulse buyer directly at the point of discovery.
Right.
You're scrolling, you see a viral makeup tutorial, and you buy the product without ever leaving the video player.
Here's where it gets really interesting, and honestly, where I have to push back on this entire narrative.
Okay, let's hear it.
Are they trying to be too many things to too many people? Just listen to the sheer scope of the initiatives we just listed. They are pushing into the UK luxury market with physical stores. They are diving into the social commerce Wild West with TikTok Shop.
True.
They are expanding into K-beauty and wellness with a new digital marketplace. Oh, and they are simultaneously starting construction on a brand new Northwest Regional Distribution Center to open in 2027.
It's a lot of plate spinning.
Doesn't this dramatic lack of focus risk diluting their core U.S. brick-and-mortar advantage, especially when you have competitors like Sephora, Amazon, Target, and, nimble direct-to-consumer brands relentlessly coming after their market share?
Your skepticism mirrors the exact debate happening on institutional trading desks right now. The scope is sprawling. But if we connect this to the bigger picture, management defends this multi-front war as a necessary evolution, not a distraction.
How so?
Ulta's entire unique value proposition has always been the low deluxe model. They are the only place where you can buy a $5 mass market lip balm right next to a $150 prestige fragrance.
Right.
To keep that specific flywheel spinning, you need constant newness. You need the K-beauty trends. You need the wellness gadgets like Therabody. You need the celebrity halo from Selena Gomez's Rare Beauty.
Yeah, management explicitly noted on the call that 20 to 30% of their total growth comes entirely from newness.
Yeah.
The consumer demands constant novelty.
Exactly. Without that constant influx of the new and the viral, the low deluxe model stagnates. The investments in AI personalization, the push into TikTok, the Space NK acquisition, these are all desperately needed pipelines for that newness.
To defend the moat.
Right. They are designed to defend the moat. However, the market's violent reaction to the SG&A spike is heavily signaling that the era of giving retailers a free pass for top-line growth is definitively over. Investors are demanding strict, visible, and immediate returns on these investments.
And that profound tension between long-term empire building and short-term profit demands sets the perfect stage for the final piece of the puzzle, the guidance.
The guidance was rough.
The historical results were messy, but the FY 2026 guidance is what truly spooked the street and sent the stock off a cliff.
We are entering the FY 2026 show me story. The market is demanding proof.
Let's lay out the numbers they projected. Net sales growth is pegged at a modest 6 to 7%. Comparable sales are expected to slow down significantly to 2.5 to 3.5%.
Which management quickly noted is just aligning with historical industry averages of 2 to 4%.
Sure, but the real disappointment, the dagger to the valuation, was the EPS guide. Earnings per share is the ultimate bottom line scorecard for investors, and Ulta guided for an EPS of $28.05 to $28.55.
Yep.
That entirely lacked the upside the buy-side analysts were modeling into their spreadsheets.
And we must also layer in the macroeconomic shadows hanging over that cautious guidance. CEO Keisha Steelman was notably sober during the commentary.
She really was.
She specifically flagged a value-focused consumer who is becoming increasingly discerning and, frankly, fatigued with their spending. Furthermore, she pointed to rising global conflicts as potential disruptors to supply chains, economic conditions, and overall consumer confidence in beauty spending.
Yet, despite acknowledging that intense consumer pressure and the search for value, she was adamant during the Q&A session that Ulta will not accelerate their promotional cadence.
Nope, they are holding the line.
They are flat out refusing to heavily discount their products. They are trying to maintain pricing integrity.
And holding the line on pricing integrity is vital for their relationships with prestige brands. I mean, a luxury fragrance house will pull their products from your shelves if you constantly discount them by 30%.
Because it destroys their brand equity.
Exactly. So strategically, avoiding promotions is sound. Tactically, however, it is terrifying for investors staring down a decelerating comp. If you refuse to put items on sale while the consumer is desperate for a bargain, you risk a severe drop in foot traffic.
Makes sense.
This raises an important question regarding the timeline for margin recovery. Management made it very clear to the analysts on the call. The first half of FY 2026 is going to look incredibly rough on paper.
How much pain are we talking about for the first 2 quarters?
Ulta explicitly stated they expect double-digit SG&A growth in the first half of the year. They have to lap the Space NK acquisition, which didn't happen until July of last year.
Meaning the first 6 months of this year will look bloated by comparison.
Precisely. They also have to annualize the heavy marketing and payroll investments they made in the back half of last year. They are essentially asking investors to endure 6 months of guaranteed, painful margin compression before any potential leverage or profitability materializes in the second half of 2026.
So what does this all mean for the listener analyzing this stock?
It means the fundamental narrative for Ulta has shifted permanently. They are no longer a hyper-growth, purely domestic retailer that gets rewarded with a premium multiple just for beating revenue estimates.
Right.
They have morphed into a mature, increasingly complex, globalizing platform. 2026 is unequivocally a transition year. The burden of proof is entirely on management now.
They have to deliver.
They have to prove that this elevated billion-dollar cost structure can actually generate operating margin expansion by Q3 and Q4, or the market will continue to reprice them lower.
To recap the investor context for you, Ulta's top-line execution remains virtually flawless. They are capturing market share, their loyalty program is an absolute juggernaut of consumer data, and they are out-innovating competitors on the merchandising front by securing the hottest launches.
But their margin credibility is firmly in the penalty box.
And Wall Street notoriously lacks the patience to wait around in the penalty box while a company reorganizes its supply chain.
They really do.
Which brings us to my favorite part of the show. We are going to transition into our signature trade pitch. I'm going to put on my hedge fund analyst vest, step into the investment committee room, and pitch you a hypothetical trade based on everything we just discussed.
I love this part.
But first, our crucial reminder. This is not financial advices segment. The following is strictly for educational and entertainment purposes. We are exploring market mechanics and hypothetical scenarios to help you understand how institutional capital thinks, not telling you what to do with your personal portfolio. Always do your own due diligence.
Standard disclaimer applied. Let's hear the pitch.
All right, committee. Here is the pitch. I call it the mean reversion makeover.
Catchy.
Heading into this earnings print, Ulta's stock was on an absolute tear. Depending on exactly where you measure from, they were up roughly 75% to 86% over a one-year period.
Massive run-up.
They were massively outperforming broader retail benchmarks. If you look at the XRT, which is the primary retail sector ETF, or the XLY consumer discretionary ETF, over that exact same 12-month period, those baskets of stocks were only up about 13%.
So Ulta was flying way above the rest.
Ulta was priced for absolute perfection in an incredibly imperfect macroeconomic sector. My thesis is this. The 8% post-earnings drop we just saw, that $50 haircut, it is just the tip of the iceberg.
Okay, so what's the play?
We are going to execute a pairs trade. We short Ulta, and we simultaneously go long on the XRT retail ETF.
Interesting.
Here is the underlying logic. Management just looked us in the eye and essentially guaranteed ugly double-digit SG&A growth and operating margin compression for the first 6 months of fiscal 2026.
They did.
Impatient capital does not stick around for a second-half recovery story when the macro environment features rising global conflicts, inflation fatigue, and a stretched value-seeking consumer.
That's a very fair point.
Institutional money is going to systematically rotate out of Ulta while the company slogs through the unsexy, expensive integration costs of Space NK, the massive capital expenditures of building a new Northwest distribution center, and the heavy marketing spend required to build out a TikTok shop fulfillment network.
It's a lot of near-term drag.
Exactly. The trade slowly bleeds out that massive one-year outperformance gap, letting Ulta mean revert back toward the broader retail sector baseline. We hold this pair trade and close the short right before Q3 earnings, right before management actually has the chance to prove that promised margin inflection in the back half of the year.
It is a classic relative value play. You are capitalizing on the market's complete lack of patience for messy transition years.
Yep.
By pairing the short with a long position on the XRT ETF, you are neutralizing the broader retail macro risk. If the whole retail sector suddenly booms because of an unexpected interest rate cut, your long ETF position protects you.
Exactly. Hedge the macro, trade the micro.
You are isolating and betting strictly on Ulta's specific, self-inflicted SG&A timeline. It is aggressive, but given the sheer weight of the guidance they just delivered, it is highly plausible.
Again, just a hypothetical exercise, absolutely not financial advice.
Of course.
So to wrap up our deep dive into Ulta's Q4 and FY 2025 earnings, the revenue engine is roaring, the Ulta Beauty Unleashed strategy is rapidly expanding their digital and international footprint, but the soaring operational costs of that expansion have investors demanding immediate proof of profitability.
It's going to be a turbulent year for them.
We would love to hear your thoughts on this. Is management making the right long-term play by investing heavily into international expansion and social commerce? Or are they digging a margin hole they won't be able to climb out of? Reach out and let us know.
I'm really curious to hear what you guys think.
But before we go, consider this. Ulta is betting a massive amount of capital on capturing Gen Z impulse buyers with this new TikTok shop integration. They're building entirely new supply chains to ship single items to millions of scrollers.
It's a huge pivot.
But historical data across the retail sector shows that social commerce shoppers have the absolute lowest brand loyalty and the highest return rates of any demographic.
That's a scary stat.
They don't care about the retailer, right? They only care about the viral product. If Ulta is inadvertently trading their incredibly loyal, high-margin, in-store beauty enthusiasts for fickle, algorithm-driven scrollers, well, we have to wonder, are they widening their competitive moat or just filling it with a Trojan horse?
Ooh, that's a chilling thought for shareholders.
Think about that next time you see a viral makeup ad in your feed.
Hey,
Thanks for joining us on this deep dive.